Hello and welcome to the first video in Vancouver Real Estate Club's 9 insider strategies that you can use to buy real estate for no money down in Canada. So let's get started. This is the first 3. So first off, I want to ask yourself, why are you interested in real estate in the first place? The number 4 reasons, the main 4 reasons we get when we do seminars and teaching people is, number 1, is people want more time. They want more time to spend with their family, more time to spend with themselves, more time to invest and find good deals out there in the marketplace. And they just want more time. They want to free themselves for the job, which actually ties into number 4. And obviously, in order to do that, they have to make a lot more money. So that's number 2 in our list is, how do I make more money and how do I use real estate investing to make a lot more money, because it's absolutely possible. Number 3 is they have a passion for it. They've seen other people do it and they fall in love. They've perhaps owned their own property and done quite well with it over time on average, and they just have a passion for it. And then number 4 is they want to use that money and that extra time in order to free themselves, earn enough passive income in order that they can fire themselves from their job, basically fire their boss and just live their lives for themselves. So that's the 4 main reasons that people are usually, we find, are investing in real estate. Those were all my reasons as well. Next up, what you're about to learn. So a little bit about me, how I built a plus $5 million real estate portfolio from nothing, no money down, from scratch. Why profit sharing, no money down strategies are the best, absolute best way to buy real estate. Where I learned about these strategies and how much money it's cost me, but yet what it's gained me over time. How much I've invested versus how much I've gotten back in return. So those are all the things we'll be addressing. Next is, we'll be doing in this first video the first 3, and then following up with the remaining 6 closely guarded strategies for buying no money down real estate in Canada completely legally and how you can do them in Canada. Some instant action steps you can take right now to get started today so you can duplicate my success for yourself. And then the ultimate real estate secret weapon that has put thousands of dollars in my pockets that anyone can do that has no money, no credit, no real estate deals, starting from scratch. And now I'll be presenting all of that for you. Next up is, who am I? My name's Thane. Last name's Lance. I'm a realtor with Sutton West Coast. So basically before then, was a sales and marketing consultant up until about 2007. I had a client come to us and say, hey, I want to teach people to do real estate investing. Can you help me do my marketing? So we did. This client tied up 10 investment properties, development properties. He put down $100 and tied up all 10. And within about 45 days, he sold all 10 of these units, and he made basically about $100,000 in about 45 days. So we said, hey, that's pretty cool. We're going to go do that. So ever since 2007, 2008, I've been doing that full time. So I took my sales and marketing background and used it towards active real estate investing. I flipped over 100 doors since 2008. Purchased my first personal residence in 2005, bought my first apartment building with joint venture partners in 2010, created about a $650,000 net worth for everyone involved. Bought a second building in 2011. That was 20 units. I created about a $1.1 million in net worth to bring total assets under management to over $5.1 million. So 2 times nominated Investor of the Year with Creative Real Estate Wealth magazine, and also interviewed on the radio multiple times as a subject matter expert in real estate, obviously. So next up is, what else have you done? So as you can see, nominated multiple times for Top Investor of the Year from Canadian Real Estate Wealth magazine. I've been interviewed on the radio real estate show Saturday mornings with Tom Lucas. So that's on CIL 650, the radio, CBC radio as well. Obviously all over Meetup, Google, you can Google me as well, LinkedIn, Facebook, Twitter, YouTube, I'm all over the place. So next up, why no money down is the only way I feel to buy real estate. So it's the best way because most people don't have a lot of money to start with. And even if they do have a lot of money to start with, they invest 20, 30, 40, 50, 100, $200,000 of their net worth into one single real estate project. They put down 20, 30, 40% down, and then they run out of all their money and then they can't do any more deals. You've done 2, 3, if you're lucky, deals, and then you run out of money. You have to, how do I get to 5 deals, 10 deals, 15, 20? You have to do that through creative strategies, working with partners. So obviously everyone runs out of money sometime. So you need to learn these strategies now before this happens to you. So are you ready to have your life change like mine? Awesome. Let's get started and finish up this video. So first off, definition, what is an actual real estate deal? So I'm going to open up the dictionary and see what they defined it as, and then I'll see what we define it as. So first off, a real estate deal is any real estate transaction that includes a vendor or a seller and a purchaser, a buyer of real estate. So both parties negotiate and agree to set terms and price by way of a contract for purchase and sale. So that's the traditional way it's done. 99 times out of 100, 95 times out of 100, it's done that way. So there's also other creative strategies you can use. You can use a title transfers, where the title transfers, you refinance, the investor refinances. You can do a promissory note for the assets of a property. You can do a company takeover. This often happens in commercial properties. This apartment building or fourplex or duplex, whatever, is owned in a company that the assets of the company transfers over, and the new buyer takes control. Or you can do a subject to arrangement or a agreement for sale. I'm actually doing that with one of my existing properties. So you just take over the mortgage or take over the payments while the mortgage is held by the seller. So that there's lots of different ways, creative ways to do a real estate deal that are completely defined by the real estate dictionary. This is how I define it. So I take a look at a transaction and I ask, can either party add value to a property in order to create profit for themselves and the other person? And if the answer is yes, well, that's what my definition of a real estate deal is. So that's where we get started. How can we add value to ourselves and to other people? So next off, I'm going to be addressing some of the renters in the audience that are watching this video. So this is the main reason why you want to be getting into real estate as quickly as possible and stop renting. So CMHC, Canada Mortgage and Housing Corporation, has these very basic, simple stats. They compare the financial net worth between homeowners and renters. The average median net worth of renters is $14,000. The average median net worth of homeowners in Canada is $327,000. So I can let you know pretty quickly, this is why we have to be getting into buying real estate, no money down, as quickly as possible. To get in, we want to go from 14,000 to 300,000. It makes sense. Here's the stats directly from their website. These numbers are from 2005, so obviously from 2014, 2015, these numbers are even higher. So here's the $327,000. Here's the $14,000 median. Here's the average net worth. Again, this is with people's assets. 71,000 versus 380,000. So the numbers are very clear. We want to be building wealth using real estate. So let's compare ourselves to our American friends. It's even worse. So the average renter in the States only owns $2,000 or $3,000 or $4,000 or $5,000 of net worth, whereas the average homeowner owns hundreds of thousands of dollars. So it's even worse to our neighbors to the south. So why are we doing this as well? What are some additional advantages? So when you're purchasing real estate for investment purposes and for your own purposes, basically you want to be using real estate as a diversification. So if you have all your money in stocks and bonds, you want to be putting some of your money into real estate. 20, 30, 40% of your net asset value you want to be putting into real estate. So don't overinvest in the stock market. In real estate, the bank will give you 80% of the money to purchase a property. So you can put down 20 and the bank will give you 80. Or you can put down 5 and the bank will give you 95 if you're buying your own personal residence. So you're able to use other people's money. Use the bank's money. And even if you need to come up with money for the 20% down payment, you can use investors' money, private lenders' money in order to do that. So real estate allows you to tap into other people's OPM, other people's money. Appreciation over time. I include some information from the TD Bank. They've done the analysis, and over the last 100 years, real estate on average in Canada has appreciated at 5.1%. So if you're purchasing an asset, and especially if you're leveraging it with 5% or 20% down, let's say you're putting down 5%, it goes up 5%. It's 5% on the total asset value. So I'll show you some numbers shortly. Mortgage pay down. So if the renter is paying down your mortgage for you, you're making between like a 14 and 18% return just on your cash-on-cash return from the renter paying your mortgage for you. So that's the massive number one way to build wealth long-term, is have the renter pay your mortgage. Preferred tax treatment. So if you own your own home, you benefit from the capital gains deduction. And if you you set up your mortgage as a readvanceable line of credit mortgage, and then you can benefit from the Smith maneuver. So the Canadian government loves people to buy real estate. They want you to buy more. So they set up the tax system in order to support you. Long-term cash flow. Let's say you have expenses of $1,000, but you're bringing in $1,200 of profit or revenue. That means you have money left over. It's called positive cash flow, passive cash flow. Real estate allows you to tap into that. Here's a visual format of what I just said. So real estate, it has a high cash yield versus stocks, bonds, and cash savings. It allows you to build up equity. It builds up equity by itself. Leverage, again, you can put down 10%, 5%, 20%, and the bank will loan you the 80%, the 90% to come up with the down pay or the remaining money. Hard assets, it's not going anywhere. You can invest in a stock, and let's say the CEO embezzles or whatever, and the stock collapses, then the company's not worth anything. Whereas a piece of real estate, it has a hard, solid value. It'll be there forever. And again, I've already mentioned tax advantages. So again, there's a nice little website called financialsamurai.com. It's from a financial investment advisor, and he actually started purchasing real estate in San Francisco a while back to do fix and flips. So you'd buy a piece of real estate, fix it up, and sell it for a profit. So on his website, Financial Samurai, he's got one web page that's 10 reasons why stocks are better than real estate. Then he has another one for 9 reasons why real estate is better than stocks. So these are just some of the things he's come up with. So obviously you're, number one, more in control, tax advantages. It's easier to analyze and quantify. You can hire an appraiser that'll say, okay, the real estate is worth X. This is what it's absolutely worth in the marketplace. A real estate agent can do that as well for you. Source of pride, you can drive by your real estate property and say, hey, this is where I'm renting out to this lovely family, and they're paying my mortgage every month, and it's awesome. Government's on your side. They're here to protect you. You can leverage with other people's money. It's a tangible asset. Less visible volatility in the market. When you're buying a piece of real estate, it goes up, it goes down, but it doesn't go up massively. It doesn't go down massively. And it's more insulated from shocks. Real estate is a local market, especially here in BC. Again, another nice little website, richardschulman.com, pulled off. This is an analysis up till 2005. So the numbers are very similar up till 2015. But these were just the numbers. He hasn't updated the website in a while. So annualized returns over time, real estate versus the TSX and the S&P. So Canadian stocks, US stocks, and then real estate using 100% money, paying it down in cash, and then using 50%. So this is just a 50% leverage. So we just compared real estate, cash on cash, with using a 50% mortgage. So again, in Canada, you can put down 20% for investment property. So real estate, obviously stock markets work better in real estate if you pay complete cash. But if you put down 50% leverage, this is what happens over time. So 2000, 2005, 20 some odd percent, 26%. 2000, 2005, again, 5-year return, 23%, far superior to the stock market. 1995, 2005, that's the crash, dot-com bubble, 2001 crash, and over 20-year return, 1985 to 2005. Again, leveraged real estate far superior. This number would be even higher if you put down 20%. So let's compare the stock market again. So let's buy an average mutual fund over from 2000 to 2011, 2012, 2013, 2014, 2015. Again, you're optimistically earning 4%. The problem is you have to minus the 2.5% MER, which is called management expense ratio. So you give your money to the mutual fund company, they pay themselves first, the expenses, and then if they earn any profit after that, you get that. So that 4%, it has to be minus the 2.5% average MER in Canada, management expense ratio. So the mutual fund companies in Canada make a lot of money off your backs. So here's the numbers for an average, peak to peak, over 1% average a year over that time frame. High tech companies, let's invest in the high tech market, the Nasdaq. It's not looking very good during that time frame. So real estate in comparison, this is what it looks like. So this is Vancouver. This is over the last 5 years. Again, people say it's going crazy, but it's not really. It's just an average, slow and steady increase, as you can see by the numbers here for the last 5 years. Let's say the last 38 years, and that's the numbers available from the real estate board. This, again, the detached properties, which is this land and a house, single-family house, that has gone up substantially, so that might be a good investment. Condos and townhouses, not as much. So they do go up over time on average, 3 or 4 or 5% above inflation. And so it's a good long-term investment. You solid buy and hold. All of our statistics we do for our deals are at 3%. So anytime you go above and beyond that, you're making good return on your money. So how do we analyze a deal? So if I present a deal to you, someone presents a deal to you, say, hey, this is a great deal. This is actually the numbers you'll use to analyze it. So first off, we want to collect all the rents, everything that you're collecting each month, add it all up. You have what's called your revenue. So you take away your costs, your property taxes, your interest, whatever. You have money left over. So that's your positive or negative cash flow, hopefully positive. Next, you have appreciation. So your property is going up in value. So you have to add that in. Next is your mortgage principal pay down. That's usually done by your renter, or it could be by yourself. You're paying down your mortgage every single month, so you're building your equity. And next step is there are tax benefits. So you have to add in, if you borrowed for investment purposes, you can claim that tax deduction. So you take all those positive benefits, add it up, and you get your annual profit. So that's a quick and dirty, easy way to analyze a real estate deal. Next up, so we want to start with the 3 basic strategies to do no money down. So we're going to start with number 1. So how it works, what you need to know, why the strategy is good, when you should use this strategy, and I'll give you a couple of tips and tricks, an example of the strategy in action. So we'll start with an unsecured line of credit. So that's going to the bank and saying, would like to purchase a real estate property, and will you loan me a little bit of money to do the down payment? So they give you an unsecured line of credit based on your income. So this is my first personal residence. Again, bought it in 2005. I went into the bank. I used an unsecured line of credit for the down payment. So I borrowed, I think, about $11,000 or $12,000. They lent it to me. I used that, declared that as my down payment. They gave me 95% loan to value mortgage secured by CMHC. Purchased the property. Purchased it for $130 in 2005, 2006, early 2006. The property went up in value 2008. It fell back down, and then right now today it's worth about $195. Bought it for $130. Cash flow a month, I'm renting it out right now, about $150 a month after all expenses, everything paid. Again, I haven't put any money out of my own pocket. The bank funded everything. Now I make money every single month from that property. Number 2, if you're lucky enough to own your own personal residence, you bought it 5, 10, 15 years ago, you can use a secured line of credit. That's taking the equity in your existing property. The bank gives you a loan against it. Use that for the down payment. So we'll go over how that works briefly. Here's a quick example. So if your home's appraised value, say, is $330,000, mortgage you owe is $200,000, you have an equity of $130,000. So $330,000 minus $200,000. 80% of that is $264,000. $264,000 minus your original equity gives you $64,000. You can use that to borrow that to invest. This is an example of a deal a friend of mine did. He purchased this investment property out in Surrey. He used $40,000 for the down payment, the 20% down payment. The $40,000 came from a secured line of credit. The interest rate at the time was 3%, so actually higher than it is now these days. $40,000 times 3% interest is $1,200 a year. $1,200 divided by 12 months is $100 a month. But the property is obviously earning far more than that. The property is cash flowing. The cash flow, additional to paying this interest, the first mortgage and the second line of credit, produces an additional $175 after everything is paid. So it's completely positive cash flow, profit-making opportunity in his pocket. So current market appraisal, bought it for $200, now worth $246. It's fantastic. So that's the second main one. So if you're lucky enough to own real estate and you can take lines of credit against your existing real estate, that's the way to do it. Again, no money down. No money down just means none of your money out of your pocket. The bank's loaning you 100% financing to do the deal. So let's go over the third strategy, and then we'll wrap up to the next video. So this is what's called seller financing. So I always recommend when people purchase, it's very done often in commercial real estate, and I'm trying to teach people to use this strategy more in residential real estate as well. So let's say the property is valued at $500,000. You'd have to come up with a 20% down payment to pay for it. 20% of 500 is 100. The bank will obviously give you a mortgage for 80%, so they'll give you a mortgage for $400,000. You ask the seller to give you a vendor take-back mortgage of, let's say, $50,000 or $100,000. So they'll give you the down payment. The bank will analyze the deal and say, yep, sounds good. And they'll give you the 80% and off you go. So your terms could be interest only. Let's say you're doing a fix and flip. So you're going to fix it up, renovate it, and sell it quickly within like 6 months or a year. So the bank, you could do a 5-year term, amortize over a long period. You can do interest only terms. Whatever you negotiate. What happens with sellers often is they sell their property and they take the profit and they put it in the bank and earn 1 or 2% interest. If they're lucky, they earn 2%. So you can say, well, I'll give you a mortgage. I'll pay you at the end. We'll pay you in 6 months or a year when I've flipped the property. And I'll give you like a 6% return or 4% return or an 8% return or 12%, whatever you give them. And the seller says, hey, that makes sense. Let's put a deal together. Because all I'm going to do is sell the property and put the money in the bank. And my stockbroker can't guarantee me more than 1 or 2% return. And so there's sellers all over the place. You'll have to maybe talk to 5 or 10, and 2 or 3 of them will agree to this. But if you're talking to 10 sellers a week and 2 or 3 of them agree, and you make an average of $100,000 or $50,000 profit per deal, you're doing pretty good. Even if you make $5,000, $1,000 profit per deal, that's per week. So you do 1 deal a week, 1 deal a month, you're laughing. It's awesome. Fantastic. So seller financing is another one. So I've got another 6 strategies coming. Those are the first 3 ones. So look forward to the next video on the 4th to 6th no money down strategies. Shall be coming shortly. So just click over to that and it should be available for you.